Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well out there. As we cruise right through midweek of another data-heavy week here. As I'm recording this well into the evening on Wednesday, October 12th, we've already had pretty hot PPI data coming in plus 0.4%. And by the time you see this, we'll have the CPI data, which very possibly could come in hot as well. And regardless, even if it's somewhat cooler than last month, you've heard the tin soldiers, as they've trotted out like they have all year from the Federal Reserve here, pretty much essentially confirming that the Federal Reserve will have their foot firmly pressed on the gas pedal at this point, regardless, unless there's real signs of cooling. And the PPI data didn't tip that cap early this week here to say that that will be the case. So again, we're still calling for 75 basis points in early November. Now, what this means market-wise, as you know, as we have been playing defense the last few months, we continually to be poised for more heavy volatility. And like I said last time, that's not to say we could not have a relief rally or a bounce, as I'll get to the technicals here in a second, but we still want to have our head on a swivel as we are firmly entrenched in really the mid-range at this point, the way we see it potentially here in the bear market. We shall see. Now, the biggest situation we're looking at technically, as the Fed maneuvers, and we'll get to the macroeconomics at the end, is that the market is pushing against the highs of 2020, pre-pandemic, and then, of course, on the rebound on the backside, late spring. However, again, with more shakeout, you heard the likes of Jamie Dimon recently and as such. If that comes to fruition on that last leg of the bear market, potentially last leg, then you could see a retesting of the 2020 lows, the trough there in early spring. Now, the solace you should take is that we've already been well positioned for this, and we'll continue to tighten down and really tighten the pipes, so to speak, to play defense as needed. However, again, we want to make sure that this is truly the case because, again, this is also a seasonally strong time of year. Now, you could throw that playbook potentially out of the window depending if the Fed continues to vigorously tighten because, as we talked about last time, there is a negative correlation, an inverse effect of the dollar staying strong and rates going up, which we've been taking advantage of for many of you. However, when that continues, equities have been suffering to the downside. It's almost been binary. So we're definitely paying attention to that indicator as well. Now, in the grander macro situation, watching some of the top economists out there discuss this really is pretty amazing. Of course, globally, we've had some real issues, and we are the strongest house on the block. You look at the Bank of England, for example, which I won't get into a diatribe. You can watch, Bloomberg or CNBC there in the morning, especially Bloomberg, who seems to focus more on that, the international picture there, not to advertise. But certainly the credit situations there have been pretty horrid. We haven't seen that here stateside just yet. But that's not to say that might not occur. So the way this generally evolves when you look at the economics of it is it starts as an interest rate risk situation, right? The Fed basically was too loose. They let it go too long with the easing. And then, of course, they've had to tighten, you've seen this year, pretty rapidly. And that's the interest rate situation, which we've seen, right? Rates going up, bonds have gone down like we couldn't remember for decades. But we haven't had a credit situation, certainly like we have on the other side of the pond, right? And what I mean by credit is, in the simplest case is that you look at high quality, for example, like treasuries, to say the least, right? Of course, this year it's been no safe haven as far as returns, but as far as guaranteed of payment, treasuries are very safe. And then you look at the high yield corporate debt markets as very risky. Now, during times of economic, shall we say, summers, when things are going smoothly like the last few years, you see what they call tight spreads. That means there's not a big delineation between interest rates and high and low quality debt, because chances of what they call default are very low because the economy's good, lending is pretty fluid, so therefore, again, most debt can be repaid. Now, once things really start to get volatile in the credit markets, after the interest rate markets we just went over, those spreads will start to widen, right? So as they start to widen, that's a higher risk environment, so you're being paid more for the risk of your debt, but there is a greater chance of default. That's usually what you see in a recession. Go back to the financial crisis, et cetera. Now, we've been calling that we've been in somewhat of a mini mild, maybe a set of rolling recessions since mid-June, but then you will see that really get exacerbated. Now, on top of that, beyond the credit situation, then you could run into a liquidity risk situation. And that generally doesn't have to be stemmed. It catches a lot of people off guard that are waiting for the fundamental signs of that, but it doesn't have to be fundamental, as many economists are actually looking at now with, of course, the institutional algorithmic trading that goes on, the technicals. Okay, the mere momentum of movements of markets could drive us into a liquidity event, which precipitated again from the cascading credit and interest rate events. Now, the good news is that we have been battening down the hatches, preparing for max volatility. So we are right there at base camp. But there's always work to be done as we continually be eternally vigilant. But that's just kind of a top-level macroeconomic view as as we see it here, and as we really overlook the landscape of what's going on. So, not to put the stagecoach ahead of the horse, we shall see. But again, we've been hearing the marching outcries from the Federal Reserve members that the Fed still has a lot of work to do, putting on that hard hat. And that really points to 75 basis points. So again, as you're watching this, we'll have the CPI data in, so we'll see how hot or cool that is. Again, if it's within a standard deviation, doesn't seem to matter, as Jerry and the Feds, don't worry, I'm not going to sing, look to be continuing to march at least throughout the end of this year in a tightening, with a tightening mandate. So with that being said, again, this probably sounds a lot like Groundhog's Day, right? But again, we continue to work, constantly to make sure that we are in the most prudent position, given the ever-changing landscape that we're all experiencing. So once again, if your situation's changed, let your personal wealth advisor know. Any idiosyncrasies there as far as within your own situation that would affect exactly how the models are applying within your given portfolios and sleeves. Other than that, we appreciate your time, your patience, and as always, most importantly, your trust. And until next time, stay frosty.